Welcome. My name is Wesley Williams. I am a California licensed attorney and a California real estate broker, and I have spent the last several years working at the intersection of payments law, digital assets, and real estate. My background in this space runs deep. I have served as in-house counsel for large national title insurance underwriters and as outside counsel representing the title and escrow industry in a wide range of transactional and regulatory matters. I have represented title companies, escrow holders, lenders, brokerages, and real estate startups in private practice across California. On the digital asset side, I have been active in the crypto and blockchain space since 2017, and I have been working at the intersection of digital assets and financial regulation continuously ever since. I also spent 4 years as corporate counsel at one of the world's largest video game payments platforms, covering anti-money laundering, Bank Secrecy Act compliance, and state money transmitter licensing. That combination of title industry depth and payments regulatory experience is exactly what this subject requires. Today's session is called Stablecoin Settlement in Real Estate. The subtitle matters: all cash, all stablecoin closings. We are talking about something narrow and specific: a buyer who wants to purchase real property using stablecoin instead of a wire transfer, and what every California closing professional needs to understand before they touch the transaction. Nothing I say today constitutes legal advice or creates an attorney-client relationship. My contact information is on screen. Reach out directly for transaction-specific analysis. We have 32 slides across 10 segments. Here is how today is organized. We start with Segment 00, a foundation on the crypto ecosystem and the federal regulatory framework that makes this conversation possible. Then Segment 01 on why this is happening right now, specifically the wire fraud problem and what stablecoin solves. Segments 02 through 06, a California regulatory core. Segments 07 through 09 cover the 5-layer settlement architecture, Federal Bank Secrecy Act and anti-money laundering compliance, and the regulatory pathway to the first compliant California closing. We close with the maturity arc, where this goes from 2026 to 2030. One scope boundary before we start. This session covers all cash, all stablecoin transactions only. No lenders, no TRID, no RESPA, no agency guidelines. If there is a purchase money loan in the transaction, this framework does not yet apply. That distinction will matter throughout. Before we talk statutes, we need a shared baseline. You do not need to be a crypto native to follow this session, but you do need to understand 3 things: what Bitcoin and Ethereum are, what a stablecoin is, and how it differs from other crypto, and why the regulatory moment we are in right now is fundamentally different from every prior attempt to apply law to digital assets. That is what Segment 00 covers. Bitcoin was created in 2009. It is a peer-to-peer digital currency with a fixed supply of 21 million coins. It started as an experiment in financial sovereignty and is now a $1 trillion asset held by BlackRock, MicroStrategy, and sovereign wealth funds. It is the reserve asset of the crypto ecosystem. Ethereum came in 2015. The critical innovation is the smart contract, which is code that executes automatically when conditions are met. Ethereum introduced programmable money. That is what makes stablecoins and programmable real estate settlement possible. The timeline on screen tells the story in 3 phases: speculation and early infrastructure through 2017, institutional recognition and the rise of decentralized finance through 2022, and the phase we are in now, regulatory integration and real-world utility. The Genius Act, the Guiding and Establishing National Innovation for United States Stablecoins Act, signed into law in July 2025, is the marker for this 3rd phase. 3 data points that explain why real estate is next. Decentralized finance protocols hold approximately $80 billion. Tokenized money market funds from BlackRock and JP Morgan are operating on public blockchains, and stablecoin supply exceeds $235 billion with monthly transaction volume that crossed $1 trillion in 2024. The missing link between crypto and the real economy is settlement. That is what this session is about. Why stablecoin specifically and why real estate specifically? 4 reasons. First, stable value. A Genius Act compliant stablecoin maintains a 1-to-1 peg with the US. Dollar backed by high-quality liquid assets, cash and treasury bills. No volatility between contract execution and close. The buyer pays exactly what the purchase agreement says. No capital gains event on the payment leg. Second, programmability. Smart contracts let you encode release conditions directly into the transaction. Contingency satisfaction, multi-party approval, time-locked reversal if the deal falls apart. Atomic simultaneous disbursement to all parties with no banking hours and no manual reconciliation. Third, regulation. This is the key point for this audience. Stablecoin is now a federally defined, supervised, Bank Secrecy Act-compliant instrument. The Genius Act established the legal framework. Permitted issuers are defined. Reserve requirements are mandated. Office of Foreign Assets Control screening is required. The regulatory floor exists. This is not 2017. Fourth, settlement speed. On-chain settlement in seconds, 24 hours a day, 7 days a week. No federal holiday delays, no wire recall risk. Cryptographic finality is technically irreversible. For a $1.5 million all-cash closing, settlement in minutes is a material fraud reduction relative to wire transfer. Why is this happening now? The answer really comes down to three numbers. First, the Federal Bureau of Investigation reported $1.7 billion in wire fraud losses in 2023. Second, the U.S. real estate market processes more than $5 trillion in transactions every year. And third, stablecoin monthly transaction volume surpassed $1 trillion in 2024. Those numbers explain why this conversation is gaining momentum right now. Traditional wire transfer infrastructure clearly has a fraud problem. Stablecoins have grown large enough to become a credible alternative. And for the first time, there is a real federal regulatory framework beginning to take shape around them. Segment 01 focuses on the infrastructure problem itself and why it has created an opening for something new. Let me describe the current wire transfer closing process out loud, and I want you to appreciate what it sounds like when you say it plainly. You execute 2 to 4 separate wire transfers, each with a 24 to 48-hour settlement window and no guarantee the money arrives when you need it. A human being has to manually verify each one before the next step can happen. There is no programmatic connection between the payment and the escrow conditions. Reconciliation is manual, and in this system with this infrastructure, $1.7 billion a year is being stolen from real estate participants. The right column is what stablecoin enables. Funds that move only when conditions are satisfied, settlement that cannot be reversed, simultaneous disbursement to every payee at close, an on-chain audit trail that is more verifiable than any wire confirmation you have ever received, automatic return of buyer funds if the transaction fails, and 24/7 availability with no banking hours. That is a better system. The question is whether we can get there under California law. The third column is the map for getting there. 7 legal questions that must be answered before any California closing professional can run a stablecoin transaction. Does the closing professional need a digital financial assets law license? Does stablecoin satisfy California's good funds law? Is stablecoin monies under Financial Code Section 17409? What does the Underwriter agency agreement require? How are the trust account and custodial wallet tracks separated? And what do activities 1 and 3 under the Digital Financial Assets Law actually require? 7 questions. By the time we reach slide 30, all 7 will have an answer. July 1st, 2026 is the date that gives this entire session its urgency. That is when California's Digital Financial Assets Law becomes fully enforceable. California Financial Code Division 1.25, sections 3101 through 3907, regulated by the California Department of Financial Protection and Innovation. If you are a title company, an independent escrow company, a Department of Real Estate broker, or an attorney who handles California real estate closings, and you want to touch a stablecoin transaction after that date, you need to have resolved your licensing position before that date. That is what this segment is about. Section 3103A defines 5 activities that trigger digital financial assets law licensing requirements. I am going to name all 5, but I will tell you right now that if you are a closing professional, only one of them is keeping me up at night on your behalf, and that is Activity 3. Activity 1, exchange or conversion, swapping or converting digital financial assets for money or other value. Classic crypto exchange function, not what closing professionals do. Activity 2, transfer, moving digital financial assets on behalf of another person. Adjacent to what closing professionals do, but the instruction-only structure handles this. Activity 3, custody. Here we go. Custody means storing, safeguarding, or maintaining custody of digital financial assets on behalf of another person. Read that one more time. On behalf of another person. Now ask yourself what an escrow company does for a living. It holds value on behalf of the parties to a transaction. If those assets are stablecoin and the escrow company holds them in a wallet it controls, the escrow company is very likely engaged in Activity 3. And Activity 3 requires a digital financial assets law license, absent a statutory exemption or a determination from the Department of Financial Protection and Innovation that no covered activity is being performed. Activities 4 and 5 are issuance and payment instruments, issuer-level activities. You are not a stablecoin issuer. These do not apply to you. The statutory definition of digital financial asset under Section 3201, any digital representation of value not issued by a government and not legal tender. USD Coin and PayPal USD are in. So is every stablecoin you would reasonably consider using in a closing. The answer to the Activity 3 problem is the instruction-only model, and I will walk through it precisely in the next segment. The short version: properly licensed custodian holds the stablecoin, the closing professional issues instructions, and the licensed partner absorbs the licensable activity. The closing professional does not perform it. Let me tell you exactly which category you are in and what it means for you. Title insurance companies, you got the best outcome at this table. Section 3103B11 provides an express escrow exemption for title insurers under the Digital Financial Assets Law. Clean statutory position. That said, the exemption addresses only the Digital Financial Assets Law. It does not clear the California Department of Insurance. It does not substitute for written underwriter approval. Two separate requirements, both non-negotiable. We will cover them in segment 05. Title agents, meaning underwriter-affiliated agencies. Your position is ambiguous. The Section 3103B11 exemption may extend to you, but that is not settled. Written underwriter approval and an agency agreement addendum are required. Assume nothing flows to you automatically from your underwriter's statutory exemption. Independent escrow companies. I want to be straight with you here because you deserve a straight answer. There is no Section 3103B exemption for independent escrow companies. The Activity 1 and Activity 3 questions are pending a Department of Financial Protection and Innovation interpretive opinion that has not yet been issued. If that opinion confirms digital financial assets law coverage applies to your activities, nationwide multi-state licensing system registration is required by July 1st, 2026. The dual account model is your structural workaround while the regulatory picture is being resolved. Department of Real Estate brokers, your position is custody dependent. No Section 3103B exemption exists for brokers. The instruction-only structure keeps you outside digital financial assets law scope, but you must document that role in writing before the first transaction, and stablecoin does not enter a Department of Real Estate trust account under any circumstances. Attorneys, under Section 3103B10, escrow performed in the course of legal practice should be exempt from digital financial assets law licensing. Your digital financial assets law exposure should be the most limited of any entity at this table. The California State Bar's conduct requirements are a completely separate track, and we address those in segment 06. The bottom line on this slide: digital financial assets, law licensing, and good funds law are separate analytical tracks. Clearing one does not clear the other. That sentence is going to come up again. This slide is doing a lot of work. 3 separate questions, each with its own answer, and the answers interact with each other. I am going to take my time here. Question 1. What exactly is a payment stablecoin under the Genius Act? Section 2 gives us 3 elements. It is designed for payment or settlement. The issuer is obligated to redeem it at a fixed monetary value, and the issuer represents it will maintain stable value. USD Coin and PayPal USD check all 3 boxes. The language that matters most for the next question: the Genius Act expressly prohibits issuers from claiming their stablecoins are legal tender, federally insured, or backed by the U.S. government. Stablecoin is not money. The federal government just told us so. Question 2. Is stablecoin monies under California Financial Code Section 17409? Section 17409A requires all monies deposited in escrow to be held in a Federal Deposit Insurance Corporation insured bank depository. That is the obstacle. Smart contract wallets are not bank depositories. The argument we are taking to the Department of Financial Protection and Innovation is that stablecoin is property, not monies. California State Bar Formal Opinion 21-0007 treats cryptocurrency as property. The Genius Act just confirmed stablecoin is not legal tender. If stablecoin is property rather than monies, Section 17409's depository mandate may not be triggered. Here is an analogy that is genuinely persuasive. California Financial Code Section 17003 defines escrow to include personal property and other thing of value, not exclusively money. Department of Financial Protection and Innovation licensed escrow companies already hold precious metals in escrow as property, and nobody argues that the gold must be in a Federal Deposit Insurance Corporation insured depository because gold is property, not monies. The same statutory logic applies to stablecoin. That is the doctrinal hook. One complication worth noting, if stablecoin is property and Section 17409 does not apply, there is also no affirmative California statute telling the escrow company how to hold non-monetary property pending close. The statute is silent. The dual account model fills that gap, which is why the model matters as much as it does. Question 3. Did the Genius Act solve this for us by preempting California law? No. Section 5. H preempts state licensing requirements applied to stablecoin issuers only. Section 17409 regulates the escrow company, not the issuer. They are different entities engaged in different activities. Section 7, F4, expressly preserves state consumer protection laws. Federal law gave us a foundation. It did not hand us a finished building. Segment 03 is where we move from identifying problems to building the solution. The Activity 3 exposure, the Section 17409 gap, the licensing uncertainty for independent escrow, all of it has a structural answer. It is called the dual account model, and it is simpler than it sounds. One rule anchors the entire structure. Stablecoin never enters the escrow company's trust account, not a suggestion, the architecture. The reason two accounts are necessary comes down to a foundational legal fact. Stablecoin is property and fiat currency is money, and property and money are governed by incompatible legal frameworks in California. You cannot hold them in the same account without creating a compliance problem on at least one of those frameworks. Account 1 is the Federal Deposit Insurance Corporation insured trust account. This is the account your escrow company has always had. Nothing about it changes. US dollars sit here, specifically dollars converted from stablecoin by the custodian per party authorization. Section 17409 governs it. Federal Deposit Insurance Corporation insured. Payees who elected US dollars get paid from here by check or wire, the same way they always have. The earnings credit your escrow company depends on, preserved on this balance. Account 2 is the digital financial assets law-licensed custodial wallet. This is where the stablecoin lives, and here is the point that holds the whole structure together. The escrow company does not control it. The custodian does. The custodian holds the private keys. The escrow company's entire relationship to this account is limited to issuing disbursement and conversion instructions. That is it. Payees who elected stablecoin receive it directly on-chain from this account. The custodian performs what would otherwise constitute Activity 3 and Activity 1 under the Digital Financial Assets Law. The escrow company is the instructing agent, and nothing more. The cardinal rule. I am going to read it exactly as written. The closing professional controls instructions. The licensed custodian controls the stablecoin. These two functions must never be performed by the same entity. If you remember one sentence from today's session, that is the one. Think of the payee election as the first new question you add to the opening of escrow process. How do you want to get paid? Stablecoin or US dollars? Every single party in the transaction picks one, and they pick it in writing at opening of escrow. Option A is the stablecoin track. The party sets up a qualifying custodial wallet, Coinbase Wallet, Kraken, Ledger, whatever they prefer from the approved list. They give you the wallet address. Before you do anything with it, you run it through the Office of Foreign Assets Control specially designated national screening. At closing, stablecoin is dispersed directly to their wallet on-chain, simultaneously with every other Option A payee. Option B is for the party who either wants traditional payment or simply does not want to set up a crypto wallet, which is going to describe a lot of sellers and agents for the foreseeable future, and that is fine. They sign an authorization allowing the custodian to convert their stablecoin proceeds to US dollars at par. The converted dollars land in the Federal Deposit Insurance Corporation insured trust account, and they receive payment by check or wire, exactly as they always have. Every party in the transaction makes this election: seller, buyer, listing agent, buyer's agent, homeowners association, every payee on the settlement statement. One exception: government entities, recording fees, tax payments. Those stay in US dollars until government systems can accept digital payment, which is not now. The election document is executed as part of the Escrow Instructions Addendum at opening of escrow. This is a signed written document, not a checkbox on an intake form. That distinction matters for your compliance file. Now that we have the payee election in place, here is exactly what the Escrow Instructions Addendum contains: 6 required elements. The payee payment election table. Every payee on the settlement statement, their option A or option B election, wallet address or wire details, irrevocable 7 days before closing. The conversion authorization language, joint instruction from all parties directing the custodian to convert stablecoin to US. Dollars at par for option B payees, identifying the custodian, the stablecoin, and the escrow company's instruction-only role. The OFAC screening consent, each option. A payee consents to wallet address screening against the SDN list before disbursement, and no transaction proceeds to a flagged address. The wallet addresses and payment instructions table. Each payee mapped to their election, address or wire details, OFAC screening confirmation date, and disbursement amount. The acknowledgement of irreversibility. All parties acknowledge that on-chain transactions are cryptographically final and cannot be reversed or recalled, unlike a wire, and that distinction matters for the closing professional's liability exposure. The custodian identification and SOC2 disclosure names the specific DFAL licensed or OCC chartered custodian, notes custodial wallets are not FDIC insured, and references the custodian's SOC2 Type 2 certification on file. 9 required disclosures. These protect the closing professional if a transaction goes wrong. Genius Act compliant status of the specific stablecoin. Not legal tender and not FDIC insured, even though the issuer's reserves sit at an FDIC insured institution. Third-party custodian identity. Stablecoin held in a segregated custodial wallet at the named custodian, not in the escrow company's trust account. Irreversibility acknowledgement. The escrow company's instruction-only role. Conversion authorization for option B payees. USD equivalent controls for deed recording, documentary transfer tax under Revenue and Taxation Code, Section 11932, the Preliminary Change of Ownership Report, and 1099S Gross Proceeds Reporting, Independent Counsel Acknowledgement, and OFAC Screening Process. The Addendum template is one of the 6 downloadable resources on the final slide. The 9 disclosures are not aspirational. They are what a defensible closing file requires. Not every stablecoin qualifies for a California all-cash closing. Segment 04 starts with which ones do and why, and then tackles what is honestly the most technically challenging obstacle in this entire framework: California's Good Funds Law. That statute was written in 1990. The internet was barely a consumer product. Blockchain was not a concept. So the question we are working through here is what happens when a 35-year-old statute meets a payment instrument its drafters could not have imagined. Qualification first. Under DFAL Section 3103, the stablecoin issuer must be a DFAL applicant or licensee, a bank, California licensed trust company, or a nationally chartered trust association maintaining eligible securities at 1-to-1 reserve parity. USD Coin and PayPal USD satisfy these requirements. Maintain a written DFPI certified stablecoin whitelist and update it as certification status changes. The good funds problem. Insurance Code Section 12413.1 permits disbursement only of good funds, collected, irrevocable, and available. 2 provisions create the obstacle. Section 12413.5 requires funds in an FDIC-insured bank depository. A smart contract wallet is not one. Section 12413.1 C defines electronic payment by reference to a 1990 Regulation CC definition covering wire and ACH only. Blockchain postdates that by 2 decades. The resolution path. On the FDIC question, if the stablecoin's reserves sit in an FDIC-insured institution, the underlying dollar may satisfy Section 12413.5 through the reserve structure. Anchorage Digital, under an OCC National Trust Charter, satisfies that directly. USDC's reserves at BNY Mellon and Customers Bank satisfy through the Reserve Bank framework. Hard warning: Wyoming Special Purpose Depository. Institutions are not FDIC insured. Do not use one as your sole custodian for California good funds purposes. On finality, an automated blockchain settlement confirmation referencing the on-chain transaction hash and confirming cryptographic finality should satisfy the written final settlement notice standard under Section 12,413.1d. On-chain finality is more verifiable and more irreversible than a wire confirmation number. One additional angle for regulatory submissions. Section 12,413.1 uses funds, which is broader than monies, as used in Section 17409. If the regulator places stablecoin entirely outside Section 12413.1, the dual account model may still provide equivalent consumer protection the good funds law was designed to guarantee. Frame that as a fallback safe harbor request. Give the regulator two paths to a yes. First steps: title companies send a written California Department of Insurance inquiry letter before any live transaction, covering Sections 12,413.5 and 12,413.1d. Independent escrow companies seek a DFPI interpretive opinion on the three core questions. All entities confirm an FDIC-insured bank partner in writing and get the custodian's SOC2 Type 2 audit report in the closing file. Segment 05 is directed at title company professionals, but if you are an independent escrow company or an attorney who works alongside title on these closings, this material applies to your transactions too. There are two documents that every title agent needs before running a stablecoin closing, and neither one is optional. The Digital Financial Assets Law Section 3103(b)(11) exemption cleared one hurdle for title companies. Here's what it did not clear: the California Department of Insurance, which regulates what title companies are actually permitted to do in an escrow function. Insurance Code Section 12389 governs permissible escrow activities for title insurers. Stablecoin receipt may constitute a material expansion of that function, requiring California Department of Insurance review. The required action is a written California Department of Insurance inquiry letter before any live stablecoin transaction. Two questions. Does this dual account structure satisfy good funds under Section 12413.5, and does on-chain finality satisfy the written notice requirement under Section 12,413.1d? On Underwriter approval, every title agent operates under an agency agreement that requires Underwriter approval for material changes to closing procedures. Stablecoin settlement is almost certainly a material change, and the argument that it is not would be very difficult to sustain. The consequences of proceeding without approval are significant: breach of the agency agreement, errors and omissions policy exclusion for stablecoin-funded transactions, and Underwriter refusal to issue the title insurance policy, which effectively means the closing does not happen. Now, the distinction I want every title agent in this room to understand clearly, because I see this confusion regularly: an enterprise bulletin is a policy statement. Stewart, Fidelity National Financial, First American, Old Republic, WFG, these underwriters issue network-level bulletins to their entire agent bases, setting stablecoin underwriting standards. One bulletin reaches thousands of agents simultaneously. It tells you what the underwriter will approve in principle. That is useful, but it is not a contract. An agency agreement addendum is a bilateral amendment to your specific agency agreement. It modifies your actual contractual obligations and the underwriter's actual coverage commitments to you personally. If a stablecoin claim arises, the agency agreement is what controls, not the bulletin. An agent who has the bulletin but not the addendum has a policy statement and no contractual protection. You need both documents. This is not a fine point. It is the difference between being covered and thinking you are covered. Attorneys, this segment is yours, and for everyone else in the room who works with attorneys on these closings, stay with me, because the structure your attorney uses will affect how the transaction is documented and how the compliance file is built. 3 governing authorities: California Rules of Professional Conduct. Rule 1.15, California State Bar Formal, Interim, Opinion, number 21-0007, and the Client Trust Account Protection Program. Let me walk through what they actually require. California State Bar Formal Interim Opinion Number 21-0007 is the document that governs this. The headline, and I want to be clear about this because there is sometimes confusion, is that California attorneys can hold stablecoin in escrow. The opinion does not prohibit it. What it does is attach 4 mandatory conditions, and every one of them maps onto the dual account model we already discussed. Condition 1, segregation. Stablecoin is property, not currency. It cannot go into an interest on lawyer's trust account. Full stop. It must be held in a separate, segregated digital wallet. In practice, the custodial wallet in the dual account model. The interest on lawyer's trust account receives US dollar proceeds only after conversion. Condition 2, commercially reasonable safeguards. The attorney must demonstrate safeguards appropriate to the technology. A system and organization controls 2 Type 2 certified custodian holding the stablecoin should satisfy this standard. The Office of Foreign Assets Control Screening Protocol must be documented. The custodian certification goes in the client file. Condition 3, competence. This one gets underestimated. The attorney must actually understand the cybersecurity risks involved, how private key management works, and the characteristics of the specific stablecoin being used. Genius. Act-compliant stablecoins reduce but do not eliminate technological risk. Competence means understanding the structure you are adopting, not just adopting it because someone told you it is compliant. Condition 4, Client Trust Account Protection Program Annual Certification. California's Client Trust Account Protection Program requires attorneys to file an annual self-assessment of their Rule 1.15 compliance. If you are handling stablecoin in escrow under the dual account model, that activity needs to be reflected in your annual filing. Update your self-assessment to address the custodial wallet structure and its separation from the interest on lawyer's trust account. A full attorney-specific analysis, Rule 1.15, Opinion 21-0007, the Client Trust Account Protection Program, and the Financial Code Section 17006 Escrow Law Exemption, is available from me directly as a supplemental resource. Up to this point, we have been analyzing problems and building conceptual answers. Segment 07 is where we put it all together into an operational architecture, the 5-layer compliance stack, the actual custodians you would call today, and 4 structural workarounds that are available under existing California law right now. No statutory amendment required. Think of this as the compliance architecture for a stablecoin closing. 5 layers. Every compliant California closing rests on all 5 of them. If any layer is wrong, the whole structure is compromised. Layer 1 is the stablecoin itself. Genius. Act compliant USD coin or PayPal USD. 1-to-1 high-quality liquid asset-backed Bank Secrecy Act anti-money laundering compliant. Classified as a non-security. Maintained on a written Department of Financial Protection and Innovation certified whitelist. No algorithmic stablecoins, no stablecoins that do not satisfy the Genius Act requirements. This is the foundation. If the stablecoin is wrong, everything above it is wrong. Layer 2 is the Federal Deposit Insurance Corporation insured bank or Office of the Comptroller of the Currency Chartered Custodian. Anchorage Digital, Coinbase Institutional, BitGo. This entity holds the actual stablecoin in segregated custodial accounts. It controls the private keys. System and organization controls 2 Type 2 audit, Office of Foreign Assets Control Screening, immutable audit trail. This is the licensed entity that performs the digital financial assets law-regulated activities, not the closing professional. Layer 3 is the settlement platform. System and organization controls 2 Type 2 certified. It provides stablecoin whitelisting, real-time Office of Foreign Assets Control Screening, smart contract release conditions, conversion instruction routing, human-in-the-loop disbursement approval, and the audit trail. This is the operational layer between the closing professional's instructions and the custodian. Layer 4 is the closing professional, instruction only, escrow company, title agent, or attorney. Issues disbursement and conversion instructions only. Never takes custody, never holds private keys. Manages both tracks, stablecoin from the custodial wallet and US dollars from the trust account. Layer 5 is the disbursement recipients. Option A, payees receive stablecoin on-chain to their Office of Foreign Assets control-screened wallet address. Option B, payees receive US dollars from the trust account. No lender payoff in all cash transactions. One more time because it belongs at the end of every slide in this session. The closing professional controls instructions. The licensed custodian controls the stablecoin. These two functions must never be performed by the same entity. Theory is useful. Names are useful. Let me give you both. Anchorage Digital operates under an Office of the Comptroller of the Currency National Trust Charter. That is the strongest regulatory position available for California good funds compliance. Client assets are off balance sheet under the National Bank Act. The Office of the Comptroller of the Currency supervises them directly, so no separate digital financial assets law license should be required. The charter should satisfy Insurance Code Section 12,413.5 through the Reserve Bank structure. This is generally considered the gold standard option for a California stablecoin closing. Coinbase Institutional, also called Coinbase Prime, is digital financial assets law licensed in California. Segregated accounts, system and organization controls 2 Type 2, real-time Office of Foreign Assets Control screening via application programming interface, and webhook-based on-chain confirmation delivery. The most operationally accessible option for independent escrow companies and mid-sized title companies that need to stand up a program without a large institutional infrastructure team. BitGo is digital financial assets law licensed with a trust company subsidiary that provides additional regulatory coverage. 3 of 5 multi-signature key management system and organization controls 2 Type 2, Institutional Office of Foreign Assets Control screening, widely used by institutional asset managers. Fireblocks, and this is a distinction worth making clearly, is the infrastructure layer, not the custodian. Multi-party computation key management, a policy engine for disbursement rules, application programming, interface connectivity to downstream custodians. Over 1,800 financial institutions use Fireblocks as the layer that connects instructions to custodian key management. Fireblocks does not hold the stablecoin, the custodian does. Kraken operates a Wyoming Special Purpose Depository Institution charter, plus a Department of Financial Protection and Innovation licensed California exchange subsidiary. For California good funds purposes, you need written confirmation of the Federal Deposit Insurance Corporation insured reserve bank structure before relying on Kraken for Section 12,413.5. Wyoming Special Purpose Depository. Institutions are not Federal Deposit Insurance Corporation insured, and that is a hard stop for California good funds purposes. One of the questions I get from closing professionals is, do I have to wait for the legislature to fix the statutes before I can do any of this? The answer is no. 4 structural solutions are available under existing California law today. The first one is instruction-only delegation, which is the primary structure the entire dual account model is built around. The escrow company never touches the stablecoin. The custodian holds it. The escrow company instructs. This single structural decision may eliminate Activity 3 exposure, reduces Activity 1 to an agency question, and significantly reduces money services business classification risk. The legal foundation is agency law, which has long recognized that an agent transmitting an instruction does not independently perform the underlying licensed act. The bank wires, the exchange converts, the escrow company instructs. The second workaround is the time-locked smart contract. Instead of depositing stablecoin into a human-controlled wallet, the buyer deposits into a smart contract with encoded release conditions, contingency satisfaction, escrow officer approval, release date. If conditions are not met, the contract automatically returns the stablecoin to the buyer. No escrow officer intervention required. The escrow company triggers the release condition. It never holds the asset. The custody element of Activity 3 should not be present in the escrow company's operations under this structure. The third is the multi-party key structure. 3 keys govern the transaction wallet. The custodian holds asset control. The escrow company holds approval authorization only. The settlement platform holds technical execution. 2 of 3 signatures are required for any disbursement. The escrow company's key is an approval key, not a custody key. It never has unilateral control over the stablecoin, which mirrors the counter-signature requirement in traditional fiat wire transfers. The fourth is the platform as escrow agent structure. A digital financial assets law license settlement platform acts as escrow agent of record for the stablecoin. The title company or independent escrow company acts as settlement agent for the traditional closing functions, document preparation, deed recording, title insurance. The platform bears the digital financial assets law custody obligation. The licensed closing professional bears the title and settlement function. This requires a written co-agency or sub-escrow agreement, expressly dividing the licensed activities between the two entities. Segment 08 is the federal layer. These obligations exist regardless of how California resolves the digital financial assets law and good funds questions. You cannot clear the state analysis and assume you are done. Federal law applies independently, and it has its own compliance requirements that attach the moment stablecoin is involved in a transaction. 3 topics, all federal, all separate from the California analysis. First, money services business classification. The Bank Secrecy Act category that matters here is money transmitter. Under 31 CFR Section 1010.100 and Financial Crimes Enforcement Network guidance from 2013 and 2019, closing professional who receives and disperses stablecoin on behalf of others may be classified as a money transmitter, which means registering with the Financial Crimes Enforcement Network and maintaining an anti-money laundering program. The instruction-only safe harbor is the answer. A closing professional who issues disbursement and conversion instructions to a licensed custodian without taking possession of or exercising dominion over the stablecoin has the strongest available argument against money transmitter classification. Document that role in writing before your first transaction. Second, currency transaction report and suspicious activity report obligations if you are a money services business. Currency transaction reports are required for transactions over $10,000 under 31 CFR, Section 1010.311, and that threshold is met virtually every real estate closing. Suspicious activity reports are required for $5,000 plus transactions involving suspected illegal funds or no apparent lawful purpose under 31 CFR. Section 1022.320. Primary stablecoin triggers, Office of Foreign Assets, control flagged wallet addresses, structuring patterns, and high-risk counterparties. Every sending and receiving wallet must be screened before disbursement. Third, customer due diligence and the travel rule. Customer due diligence under 31 CFR, Section 1010.230, requires you to identify beneficial owners holding 25% or more of any legal entity customer plus a control individual. That applies to entity-owned property transactions. The travel rule at 31 CFR Section 103.33 requires passing identifying information with fund transfers of $3,000 or more. Design your closing file now to capture travel rule data. The Financial Crimes Enforcement Network's virtual asset service provider rulemaking is coming, and you want your file format to be ready. Regardless of money services business classification, every stablecoin closing file should contain the on-chain transaction hash and block confirmation, wallet addresses for all parties, Office of Foreign Assets control screening results with the platform certificate, beneficial ownership documentation for entity buyers and sellers, signed payee election documents, conversion authorization language, and the custodian's system and organization controls to Type 2 certification. 5 topics on one slide. I will be efficient. Uniform Commercial Code. Article 4. A governs wire transfer finality in California. On-chain stablecoin transactions are not Article 4A funds transfers. They are peer-to-peer transfers of digital property. Here is something that surprises people. Blockchain finality is technically superior to Article 4A. You cannot reverse an on-chain transfer the way you can recall a wire. That strengthens the argument that on-chain confirmation may satisfy Insurance Code Section 12,413.1D's written notice requirement. One gap to note, California has not yet enacted Uniform Commercial Code, Article 12 on digital assets, approved by the Uniform Law Commission in 2022. That is a 2026 to 2027 California legislative priority. On smart contract enforceability, the Federal Electronic Signatures in Global and National Commerce Act and California's Uniform Electronic Transactions Act under Civil Code Section 1633.1 both give electronic contracts the same legal effect as paper. Drafting requirement. Your purchase agreement and escrow instructions must expressly consent to electronic contracting. Define the smart contract release conditions and specify that on-chain confirmation constitutes performance. Consumer disclosures. No TRID, no RESPA, no closing disclosure in all cash transactions. But Consumer Financial Protection Bureau authority over unfair, deceptive, or abusive acts or practices extends to settlement service providers in consumer transactions regardless of financing. Written pre-closing disclosures and written acknowledgement from buyer and seller are required. On custodian insolvency and key risk, the Federal Deposit Insurance Corporation and Securities Investor Protection Corporation do not cover cryptocurrency wallets. Office of the Comptroller of the Currency Chartered Custodians are the strongest option here. Client assets are off balance sheet under the National Bank Act. For non-bank custodians, verify client asset segregation in the system and organization controls too. Report and confirm the custodian's crime and fidelity insurance coverage before your first transaction. Finally, errors and omissions and cyber insurance. Ask your carrier 3 questions in writing before your first stablecoin closing. Is this transaction covered? Is wallet compromise covered? And is regulatory enforcement loss covered? Review your cyber policy for digital asset sublimits. The question I get most often after presenting this material is, okay, this all makes sense conceptually, but how do I actually move it forward? How do I get from understanding this framework to running a compliant transaction? Segment 09 is the answer. The interpretive letter framework that applies in every state and the 7-step operational pathway to the first compliant California stablecoin closing. An interpretive letter or regulatory opinion request is a formal written submission to a regulator describing your specific structure and asking how the law applies to it. Regulators respond in writing. The response creates a documented compliance position you can rely on. It is the fastest legally defensible path to operating before the statutes fully catch up with the technology. 3 subjects, every state, every jurisdiction that has a good funds statute. Subject 1, stablecoin as payment medium. Does a Genius Act compliant stablecoin held at a Federal Deposit Insurance Corporation insured bank partner's custodial account satisfy the state's definition of good funds, collected funds, or final payment? The threshold issue is whether stablecoin is monies or property under the state statute. California, California. Department of Insurance for the good funds question. Department of Financial Protection and Innovation for the digital financial assets law questions. Other states. Florida. Office of Insurance Regulation, Texas Department of Insurance, New York Department of Financial Services. Subject 2, atomic settlement via smart contract. Does on-chain cryptographic finality constitute final settlement for the state's good funds notice requirement? Frame it as a finality equivalence argument. On-chain settlement is more final than a wire, more verifiable than automated clearinghouse, and the transaction hash is more auditable than a wire confirmation number. Does a smart contract governing escrow release conditions constitute a valid escrow agreement under the Electronic Signatures in Global and National Commerce Act and Uniform Electronic Transactions Act? Yes, if parties consented. The regulator needs to confirm its examination standards will accept smart contract governed disbursement. Subject 3, custodial wallets alongside trust accounts. Do not frame this as, can I replace the trust account? That language will make any regulator uncomfortable. Frame it instead as, does the dual account instruction only structure satisfy the consumer protection purpose that the trust account requirement was designed to serve? Give the regulator 2 paths to a yes. Either the structure may satisfy the statute, or it may provide equivalent protection outside the statute, and a safe harbor or no action position would be appropriate. All right, there are 7 steps. Do them in this order. Step 1, choose your stablecoin, USDC or PayPal USD only. Maintain a written DFPI certified whitelist, no algorithmic stablecoins, no exceptions. Step 2, engage a qualified custodian, FDIC insured bank or OCC chartered custodian, Anchorage Digital, Coinbase Institutional, or BitGo. Get FDIC insurance confirmed in writing before transaction 1. Step 3, send the regulatory inquiry. Title companies, written CDI letter. 2 questions. Does this satisfy good funds? And does on-chain finality satisfy 12,413.1? D. Escrow companies. DFPI interpretive opinion request. Frame the 17409 question as property not monies. Stablecoin is not legal tender under Genius. Bar opinion 21-0007 classifies crypto as property, and DFPI licensed escrow already holds precious metals as property. Give the regulator 2 paths to yes. Step 4. Get written underwriter approval plus the agency agreement addendum. The bulletin states policy. The addendum is your contractual protection. You need both. The bulletin alone is not enough. Step 5. Confirm DFAL status and coverage. Escrow companies. Get the DFPI interpretive opinion before assuming coverage. If confirmed, NMLS registration is required by July 1st, 2026. All entities E&O written confirmation plus a cyber rider. Step 6. Build the closing file. Draft payee election documents. Execute the escrow instructions addendum with all 9 required disclosures, conversion authorization, and payee elections. SOC 2 in the file. On-chain confirmation equals written notice under 12,413.1 D. OFAC documentation throughout. Step 7. Confirm dual account roles. Trust account for fiat. Custodial wallet for stablecoin. DRE broker role is instruction only, documented in writing. No stablecoin custody through a DRE trust account, ever. The technology is ready. The federal framework exists. The question is whether California's closing industry builds on it now or waits until it is built around them. I want to close with a clear-eyed look at where this is going. What distinguishes a well-reasoned legal position from speculation is the ability to explain the trajectory, not just the current state. Phase 1, now through end of 2026. We operate within existing law using instruction-only workarounds. The dual account model is functional. Regulatory inquiries are in progress. CDI letters and DFPI interpretive opinion requests, underwriter approval, and agency agreement addenda are being negotiated. The first all-cash stablecoin closings will use Anchorage Digital and Coinbase Institutional as custodians, with manual closing file documentation and human-in-the-loop disbursement approval. Success metric: the first compliant California stablecoin closing with a documented written regulatory response in hand. Phase 2, 2026 to 2027. The regulatory scaffolding goes up. DFPI issues a written interpretive opinion indicating the instruction-only dual account structure may not trigger Activity 1 or Activity 3. CDI issues guidance that on-chain confirmation may satisfy Section 12,413.1. 2 or 3 major underwriters issue enterprise bulletins. The legislature introduces amendments to Sections 17409 and 12,413.1. UCC Article 12 is introduced. Phase 3, 2027 to 2028. The statutory framework is amended. Section 17409 is amended to add DFAL licensed custodians as qualifying depositories alongside FDIC-insured banks. Section 12,413.1 is amended to add Genius Act-compliant stablecoins as enumerated good funds. UCC Article 12 is enacted in California. ALTA issues a stablecoin endorsement form. The first California county recorder accepts electronic recording with blockchain anchoring. Phase 4, 2028 to 2030. Tokenized title records and DeFi integration. Recording statutes recognize blockchain-based ownership records. County recorders integrate with permissioned blockchains. The first California deed of trust is encoded as a smart contract with automated lien release on payoff. Title insurance evolves to cover smart contract execution risk and custody chain integrity. The professionals in this session, the ones who understand this infrastructure now, who have already started the regulatory process, who are building the files and the relationships, are the ones who will set the standard for the next generation of California real estate practice. That is not hyperbole. That is how infrastructure transitions work. That is the session. 32 slides, 10 segments, and the full California regulatory picture for stablecoin real estate settlement. 6 resources are available to anyone watching. The stablecoin escrow instructions addendum template, the DFPI interpretive opinion request with the 3 questions pre-drafted, the CDI inquiry letter template, the agency agreement addendum with the 6 provisions you need to negotiate, the custodian engagement checklist, and the state-by-state feasibility checklist. For practitioners working across multiple jurisdictions, contact me directly and I will get them to you. I want to close with one thought. The question I get more than any other when I present this material is whether any of this is actually going to happen. My answer is always the same. $235 billion in stablecoin supply and $1 trillion in monthly transaction volume is not theoretical. The question is not whether this happens. The question is whether your practice is ready when it does. If you have questions about anything covered in this webinar, or if you would like to discuss retaining me for transaction-specific analysis, reach out directly. Call, email, or DM me. My contact information is on screen. California Bar, number 269157. California DRE Broker, num 01736317. Nothing in this presentation constitutes legal advice or creates an attorney-client relationship.